Imagine waking up one morning to realize that the biggest enemy to your financial future wasn't the stock market, the economy, or bad luck. It was the very system you trusted to grow your money. The brokers, the glossy ads, the experts with perfect suits and perfect promises, all taking their cut long before you see yours. Now imagine if someone came along and flipped that system upside down, saying, what if investors actually owned the funds themselves? What if we stopped selling performance and started serving people? That simple act of rebellion didn't just change portfolios, it changed lives, and it forever redefined what it means to invest with common sense. Let us imagine for a moment you hold in your hands not a handful of picks and hopes, but a full ownership ticket to the broad stock market. You're not chasing tomorrow's winner. You're simply participating in the entirety of the public companies that make up the economy. This notion of buying the whole market is not glamorous, it is not flashy, but it is powerful because it acknowledges a truth many refuse to accept. You cannot reliably pick the winning stocks, but you can reliably own the market. When you purchase a broad-based fund that mirrors the stock market, you are acknowledging that the market's collective outcome is what matters, not your ability or someone else's to find the next great company. The market returns consist of the growth of businesses, reinvestment of profits, dividends paid out, companies rising or falling, and when you own the sum total, you are entitled to your fair share of that growth. The alternative is to pick individual stocks, to bet on a small number of companies, and to hope you're right more often than you're wrong. Statistically, you're not. Research and experience show the odds are against that kind of active selection. Owning the whole market mitigates the many forms of risk you face when you try to pick winners. There's stock risk. What if your chosen company falters? There's style risk. What if value or growth or small cap is suddenly out of favor? And there's manager risk. What if the person you chose to trust does worse than the market? By getting broad exposure via the entire market, you effectively say, I will accept market risk, which is appropriate when you're invested in stocks, and let the economy reward me over time. You won't need to worry about whether you found the right stock at the right time in the right sector with the right manager. Costs matter. If you try to pick stocks, you often pay higher fees, incur higher turnover, pay more commissions, and absorb more hidden transaction costs. Those costs eat your returns every bit as surely as market dips. If you instead buy a broad market fund with very low expenses, you keep more of what the market gives you. The market will deliver its return, but if you hand too much of it away in fees, you reduce your outcome. That's why the buy the market approach is also a thrift approach. Spend less on costs. Let compounding work for you. Let time be your ally. Time is indeed your ally when you own broadly. When you hold for years and decades, the power of compounding, that is, returns built upon returns, begins to turn modest savings into substantial outcomes. But that only happens if you stay invested. If you chase winners, you may jump in and out. You may pay a heavy cost. You may miss the big upgrade because you sold too early or bought too late. When you hold the market, you simply contribute regularly, reinvest dividends, allow the machine to run. The market prospers over time with ups and downs, and you are at the table. Diversification is another virtue. Owning the whole market means you share in successes and also accept the lesser performers. That's okay, because the broad winners will more than offset the laggards in a mature market economy. You're not betting on singular greatness, you're relying on the aggregate of thousands of companies. That spreads risk, lowers the chances of a single failure ruining your lifelong plan. Finally, this approach aligns your interests with fundamentals, real businesses, profits, reinvestment, dividends, growth. It does not rely on sophisticated speculation on chasing hot sectors or trendy stocks. It does not rely on believing someone can outsmart the market year in, year out. It relies on acknowledging that the market is good at creating value over time and that you want a fair share, not someone else's story or guess. In that way, buying the market is common sense, but it takes courage not to chase, not to tinker, not to listen to every headline. In sum, the single best move for most investors is to own the market broadly, keep costs low, stay invested for the long haul, and let time and compounding do their work. It's not sexy, but it works. In the long run, the biggest threat to your investment success isn't the next market crash, a bad year, or even a poor economy. It's cost quiet, persistent, invisible cost. It doesn't make headlines, it doesn't scream for attention, but it eats away at your wealth day after day, year after year. Every percentage point you pay in fees, every trade you make unnecessarily, every commission that slips by unnoticed, These are dollars that could have been compounding for your future, but instead were handed away. And the tragedy is that most investors don't even realize it's happening. Let's strip this down to its simplest truth. The gross return earned by the market minus the costs of investing equals the net return that you actually receive. It's arithmetic, not theory. If the market gives 8% a year and your total costs, management fees, trading costs, taxes from turnover consume 2%, then you take home 6%. The 2% difference might sound small, but compounded over 30 or 40 years, it can mean hundreds of thousands of dollars lost. Time amplifies everything in investing, both the gains from compounding and the losses from unnecessary expense. Wall Street doesn't want you to think about this. The industry thrives on activity, new funds, frequent trading, complicated products. Each layer adds cost and each cost chips away at your return. But investing isn't supposed to be a game of motion. It's a game of patience. When you turn over your portfolio frequently, you incur not just commissions and spreads, but also taxes on realized gains. High turnover means more friction, and friction is the enemy of compounding. Quiet, low-cost ownership is boring, but boring builds wealth. Expense ratios are another hidden thief. Many investors assume a 1% management fee is a small price to pay for expertise, but consider this. The stock market's historical return might average around 8%. Paying away 1% in fees means you've given up 1/8 of your expected return before you even start. Over a working lifetime, that difference can reduce your final nest egg by 25–30%. You are not just paying a fee, you are surrendering years of future growth. That's why reducing costs isn't a minor detail, it's the most reliable way to improve outcomes. You can't control the market, but you can control what you pay to participate in it. The tragedy is that the industry sells confidence, not results. It tells you we'll outperform, so our fees are worth it. But the record shows that most funds underperform their benchmarks after costs. The simple reason is that the average of all investors' returns before costs is the market return, and after costs it must be less than the market. In aggregate, investors as a group cannot beat themselves. That's not pessimism, it's arithmetic. So what's the intelligent choice? Own broad, low-cost funds. Keep turnover minimal. Be suspicious of anything that promises outperformance in exchange for higher fees. Every dollar you save in expenses stays in your account, quietly compounding for decades. Costs are certain, future returns are not. Eliminate the certain enemy first, and you give yourself the best possible chance to capture the uncertain rewards of the market. The market is full of people who believe they can outsmart time. They jump in when they feel optimistic and rush out when fear sets in. They convince themselves that with enough data, instinct, or luck, they can capture all the upside and sidestep the downside. But decade after decade, this pursuit of perfect timing ends the same way, with disappointment. The investors who try to dance in and out of the market rarely end up wealthier than those who simply stayed put and let compounding do its work. Time, not timing, is the true ally of the investor. The stock market doesn't reward the person who predicts best. It rewards the person who participates longest. Compounding, the steady accumulation of returns upon returns, needs time like a fire needs oxygen. Interrupt that process with frequent trading, and you suffocate the very force that builds wealth. The irony is that most people know this intellectually but can't resist acting emotionally. They read headlines, hear forecasts, and feel the urge to respond. They move to cash during downturns, then re-enter only after the recovery has already occurred. In doing so, they miss the handful of powerful days that make all the difference. History shows that missing just a few of the best days in the market over a 20-year period can cut your total return in half. Timing mistakes are not minor, they are devastating. Staying invested, on the other hand, looks unremarkable. It doesn't make you feel clever. It doesn't get you attention. But it does something far more important. It gives your money the chance to grow undisturbed. The market's short-term behavior is unpredictable. Its long-term trend, however, has always reflected the growth of businesses, innovation, and human productivity. If you believe in progress, you must also believe in the market's long-term rise. The trick is surviving the noise in between. Compounding works like a snowball rolling down a hill. At first it's small and seems to move slowly. But as time passes, it gathers size and speed until the growth becomes exponential. The earlier you start, the more years that snowball has to roll. That's why time in the market, even when conditions are imperfect, is far more valuable than waiting for the right moment. The perfect time doesn't exist, but the cost of waiting is real and irreversible. Market timers chase control, but what they really invite is chaos. No one can consistently predict the short-term direction of prices. The world changes too quickly and emotions interfere too deeply. Instead of playing a game no one wins, choose the game that time guarantees you can win. Long-term participation. Invest regularly, hold through the storms, reinvest dividends, and let compounding take care of the rest. The market will have its bear seasons and its crashes, but those who remain invested through them capture the full cycle of recovery and growth. In the end, wealth isn't built by guessing right. It's built by staying right, staying invested, staying patient, and staying disciplined. Time will do the heavy lifting if you let it. One of the most dangerous illusions in investing is the belief that you can find the next big winner. That if you just study hard enough, follow the right trends, or trust the right expert, you'll uncover the one stock that will make you rich. This is the needle in the haystack fallacy. It sounds thrilling, but it's gambling dressed up as skill. The truth is simple. You don't need to find the needle. You can own the entire haystack, and by doing so, you dramatically improve your odds of success. That's what diversification through broad mutual or index funds gives you. Freedom from the need to predict and protection from the inevitable mistakes that come with trying to do so. Owning a wide swath of the market, hundreds or even thousands of companies, turns uncertainty into opportunity. You no longer have to guess which individual businesses will thrive and which will fail because you own them all. When innovation happens, when new industries emerge, when leaders rise and old giants fall, you're not left behind. You participate in the progress of the market itself. Diversification doesn't just spread risk, it captures human progress in its entirety. It acknowledges that no one can foresee which company will dominate the future, but the economy as a whole will keep growing, evolving, and rewarding those who stay invested. Think about what happens when you bet on a single stock or a handful of them. Your fate is tied to events beyond your control, a change in management, a failed product, new competition, or even a sudden shift in public sentiment. Even the best companies stumble. The market graveyard is full of names once considered invincible. Diversification protects you from those accidents. It ensures that no single failure can ruin your long-term outcome. It's not exciting, but it's intelligent. You trade the hope of extraordinary luck for the certainty of steady progress. Investing through broad mutual or index funds also frees you from another trap: the dependence on fund managers who claim to have superior insight. They don't. Even the most talented professionals rarely outperform the market over long periods, and when they do, it's often luck, not skill. Worse, their efforts come at a cost: higher fees, frequent trading, and tax inefficiency, all of which reduce your returns. A diversified index fund has no ego, no predictions, no turnover to chase trends. It simply holds the market and lets the results of capitalism compound for you. Diversification is, at its core, an admission of humility. It's the recognition that we don't know the future, and that's okay. Rather than pretending to have perfect foresight, you accept uncertainty and turn it into an advantage. By owning everything, you're guaranteed to own the winners, and the winners are what drive long-term market returns. The losers, the missteps, the bankruptcies, they fade into the background of a portfolio designed to capture the full sweep of growth. So forget the chase for the next hot stock or star manager. The real path to financial freedom is quieter, simpler, and far more reliable. Own the haystack, hold it for the long run, and let diversification work its quiet magic. It's not gambling, it's common sense applied with patience. For too long, the investing world was built backwards. The industry existed to serve itself, not the people whose money it managed. Fund companies were owned by outside shareholders whose goal was profit, not by the investors who supplied the capital. The result was predictable: high fees, conflicts of interest, and products designed to sell, not to serve. But there was another way, a structure built on a simple idea that the investor should be the owner, not the customer. A system where every decision would be made for the benefit of those who trusted their savings to it. That structure changed everything. When a mutual fund is organized to operate solely for the benefit of its investors, the entire equation shifts. There's no outside parent company demanding quarterly profits, no incentive to chase short-term gains, no pressure to sell new products, just to collect more fees. Every efficiency, every cost saving, every operational improvement goes directly back to the investor in the form of lower expenses and higher returns. It's investing stripped of greed or return to stewardship. That alignment of interest is what restored trust in a business that had forgotten whom it was supposed to serve. Combine that ownership model with the index concept, the idea of simply holding the market itself rather than trying to beat it, and you create something revolutionary. Suddenly, ordinary people could access the same opportunities that were once reserved for institutions or insiders at a fraction of the cost. No need for high-priced managers, no dependence on predictions, no endless churn of funds chasing yesterday's winners. The index fund gave investors a fair share of the market's return with minimal costs and complete transparency. It didn't promise miracles, it promised fairness. And fairness compounded. Every fraction of a percent saved in fees, every dollar spared from trading costs, every year of patience built up into a massive advantage over time. Investors who chose the low-cost, owner-centered structure didn't just save money, they kept what they earned. The system worked because it treated investors not as clients to be exploited, but as partners to be served. It democratized investing by making it simple, affordable, and accessible to everyone, teachers, workers, retirees, not just the wealthy or the well-connected. This model also redefined what success meant in finance. It replaced the obsession with beating the market with a more honest goal. Participating in it efficiently and fairly, it showed that capitalism could serve investors rather than exploit them, that integrity and prudence could triumph over marketing and hype, and it proved something more profound, that when you design a financial institution around the interests of its owners rather than the profits of its managers, everyone wins in the long run. The beauty of this structure lies in its simplicity. No tricks, no gimmicks, no illusion of genius, just fairness, thrift, and common sense. It's an idea that didn't just change the mutual fund industry, it changed the entire culture of investing. And for millions of people, it turned a system built for the few into one that finally worked for everyone. I will end with a simple insistence. Investing is not a spectacle, it is a discipline. If you practice thrift and fees, patience in time, and simplicity in approach, you will give yourself the best chance to prosper. The tools are not secret, they are simple, proven, and available to everyone. Do the sensible thing, own the market, keep costs low, and give compounding time to do its work. In the long run, that quiet machine, fed steadily and left to run, will do more for your future than any headline or hot idea ever will.